Question 1. A firm engaging in proprietary trading that generates quotations, executes orders, and makes markets in NMS stocks must be registered as A. Broker-dealer. B. Investment advisor. C. Transfer agent. D. Clearing firm. Answer: A. Broker-dealer. Any firm that engages in the business of effecting transactions in securities for its own account or for the accounts of others must register as a broker-dealer with the SEC and become a member of FINRA. Proprietary trading, which involves trading securities for the firm's own account, along with generating quotations and making markets in National Market System (NMS) stocks, clearly falls under the definition of a broker-dealer. This registration ensures regulatory oversight and adherence to rules designed to protect investors and maintain fair and orderly markets. Remember, if a firm is actively buying and selling securities on behalf of itself or others, it's highly likely operating as a broker-dealer. Question 2. Under FINRA Rule 5210, Publication of Transactions and Quotations, a member firm is prohibited from publishing or circulating any communication that purports to report a transaction or quotation unless it is A. Approved by FINRA in advance. B. Clearly marked as an estimate. C. A bona fide transaction or quotation. D. Disseminated only to institutional clients. Answer: C. A bona fide transaction or quotation. FINRA Rule 5210 aims to prevent the dissemination of misleading information in the market by prohibiting the publication or circulation of any communication that purports to report a transaction or quotation unless it is genuine and accurately reflects a real trade or quote. This rule is crucial for maintaining market integrity and preventing manipulative practices like spoofing or the creation of artificial market interest. Firms must ensure that any reported activity is legitimate, helping to build investor trust and ensure pricing accuracy. Always ensure that what you publish about market activity is truly authentic and verifiable. Question 3. Under Regulation NMS Rule 605, market centers must prepare monthly reports summarizing their order execution quality for all NMS stocks. Which of the following is not a required component of these reports? A. Effective spread. B. Realized spread. C. Price improvement. D. Identity of the specific institutional client for each order. Answer: D. Identity of the specific institutional client for each order. Regulation NMS Rule 605 requires market centers to publish monthly reports on their order execution quality, including metrics like effective spread, realized spread, and price improvement, to enhance transparency for investors. However, these reports aggregate data and do not require the disclosure of specific client identities, as that would violate client confidentiality. The purpose is to provide general execution quality statistics, not to reveal individual trading patterns or participants. Focus on understanding the types of aggregated data provided to assess execution quality, not granular client details. Question 4. A registered representative places a buy order for a customer's account knowing that the firm's proprietary trading desk is about to place a large block buy order for the same security, anticipating that the large order will drive up the price. This practice is known as A. Front-running. B. Layering. C. Spoofing. D. Wash sale. Answer: A. Front-running. Front-running occurs when a broker or proprietary trader executes an order for their own account or a favored customer's account based on prior knowledge of a pending large customer order that is likely to affect the market price. This unethical practice leverages confidential information to gain an unfair advantage, harming the client whose order is being front-run and violating principles of fair dealing. It's essential to remember that using non-public information about a pending large order to profit personally is strictly prohibited because it undermines market fairness. Question 5. Which of the following best describes the purpose of a risk-based capital charge for market risk? A. To cover potential losses from a decline in an issuer's credit rating. B. To account for potential losses due to adverse movements in market prices of proprietary positions. C. To protect against losses from operational failures within the firm. D. To ensure adequate capital to cover customer margin account deficits. Answer: B. To account for potential losses due to adverse movements in market prices of proprietary positions. A risk-based capital charge for market risk is a regulatory requirement designed to ensure that broker-dealers hold sufficient capital to absorb potential losses stemming from unfavorable changes in the market value of their proprietary trading positions. This charge specifically addresses the risk that the firm's own investments might decrease in value due to broad market movements or specific security price fluctuations. Firms must maintain this capital as a buffer to protect against the inherent volatility of securities markets. Understanding this helps ensure a firm's financial stability and ability to continue operating even during market downturns. Question 6. Under Regulation NMS Rule 611, Order Protection Rule, trades must generally be executed at the best available price. Which of the following is an exception to this rule? A. Intermarket sweep orders, ISOs. B. Market orders. C. Limit orders. D. Stop orders. Answer: A. Intermarket sweep orders, ISOs. Regulation NMS Rule 611, the Order Protection Rule, generally requires that orders be executed at the best available price across all protected quotations, preventing trade-throughs. However, an intermarket sweep order, ISO, is a specific type of order that allows for an exception to this rule. An ISO is marked as such and simultaneously sweeps through multiple markets to execute against visible, accessible, and protected quotations while bypassing the immediate trade-through requirement on a single market. This exception facilitates rapid, simultaneous executions across multiple venues and indicates that the order submitter is responsible for satisfying the best price requirement. Question 7. A member firm that is a market maker in an NMS stock receives an unpriced customer order to buy and immediately executes it. Under Regulation NMS Rule 604, Display of Customer Limit Orders, how must this order be handled if it improves the best bid or offer? A. It must be displayed immediately. B. It must be sent to the NYSE or NASDAQ only. C. It can be executed internally without display. D. It must be cancelled and resubmitted as a market order. Answer: A. It must be displayed immediately. Regulation NMS Rule 604, often called the Limit Order Display Rule, generally requires market makers to display customer limit orders that improve the market's best bid or offer. If a market maker receives an unpriced customer order, such as a market order, and executes it at a price that would have improved the existing BBO, best bid or offer, the market maker has effectively taken on a principal position at that price, and it becomes a customer limit order that must be displayed, if it is still executable. This rule aims to increase market transparency and ensure that the best available prices are publicly visible. Always remember that improving the BBO generally triggers display requirements for market makers. Question 8. A market maker holds a significant long position in an NMS stock. To hedge this position, the market maker executes a short sale of the same stock. Under current short sale regulations, Regulation SHO, this short sale A. is prohibited due to the current long position. B. is exempt from the locate requirement. C. must adhere to the uptick rule. D. is subject to the locate requirement. Answer: D. is subject to the locate requirement. Under Regulation SHO, all short sales, including those by market makers hedging positions, are subject to the locate requirement. This means a broker-dealer must have reasonable grounds to believe that the security can be borrowed and delivered on settlement date before executing a short sale. While market makers do have certain exemptions under Reg SHO, the locate requirement is fundamental for all short sales, including those undertaken for hedging purposes. The purpose of the locate requirement is to prevent naked short selling, which could lead to settlement failures and market instability. Question 9. FINRA Rule 5250 prohibits payments for market making or quotations. This rule is primarily designed to prevent A. Excessive commissions charged to customers. B. Conflicts of interest where firms pay for preferential treatment in displaying quotes. C. Unfair advantages given to institutional investors. D. Insider trading activities. Answer: B. Conflicts of interest where firms pay for preferential treatment in displaying quotes. FINRA Rule 5250 explicitly prohibits broker-dealers from accepting payments for publishing or displaying quotes, or for engaging in market-making activities in a particular security. This rule is designed to eliminate potential conflicts of interest where firms might be incentivized to display quotes or make markets not based on genuine market interest, but rather on payments received. The intent is to ensure that market-making activity is driven by legitimate supply and demand, promoting fair and transparent pricing. This rule helps maintain the integrity of the quotation process by ensuring market makers are driven by their own risk-reward assessment, not by payments from interested parties. Question 10. Which of the following is least likely to be considered manipulative conduct under FINRA rules? A. Spoofing. B. Layering. C. Wash sales. D. Hedging a legitimate proprietary position. Answer: D. Hedging a legitimate proprietary position. Hedging a legitimate proprietary position, which involves taking offsetting positions to mitigate risk, is a common and legitimate trading strategy employed by market participants, including market makers. In contrast, spoofing, layering, and wash sales are all manipulative trading practices explicitly prohibited by FINRA rules because they create a false impression of trading activity or prices. Hedging, when done legitimately to manage risk, is not considered manipulative. Remember, the distinction often lies in the intent, genuine risk management versus artificial market manipulation. Question 11. A broker-dealer executes a customer order for an NMS stock. Under Regulation NMS Rule 606, disclosure of order routing information, the broker-dealer must A. Disclose the identity of the customer. B. Prepare quarterly reports summarizing routing practices and payment for order flow. C. Obtain customer consent for all order routing decisions. D. Prioritize internal execution over external routing. Answer: B. Prepare quarterly reports summarizing routing practices and payment for order flow. Regulation NMS Rule 606 requires broker-dealers to disclose their order routing practices on a quarterly basis, including information about the venues to which customer orders are routed and any payment for order flow received. This rule aims to provide transparency to customers about how their orders are handled and whether the broker-dealer is receiving compensation for routing orders to specific market centers. This disclosure helps investors understand potential conflicts of interest and evaluate the quality of their broker's execution services. Question 12. A firm's net capital calculation is a critical regulatory measure primarily designed to A. Determine the firm's profitability. B. Ensure the firm has sufficient liquid assets to meet its obligations. C. Calculate the firm's tax liability. D. Assess the firm's market share. Answer: B. Ensure the firm has sufficient liquid assets to meet its obligations. The Net Capital Rule, SEA Rule 15C3-1, requires broker-dealers to maintain a certain level of readily available, liquid assets that exceed their liabilities. This calculation is a crucial financial safeguard designed to ensure that firms can meet their financial obligations to customers and other market participants, even in adverse market conditions. It provides a measure of a firm's financial soundness and helps prevent failures that could disrupt the market. Think of net capital as a firm's safety net, guaranteeing its ability to pay its debts. Question 13. Which of the following is a key characteristic of a designated market maker, DMM, on the NYSE? A. Primarily executes institutional block trades. B. Only provides liquidity during volatile market conditions. C. Has an affirmative obligation to maintain a fair and orderly market. D. Operates solely as an agency broker. Answer: C. Has an affirmative obligation to maintain a fair and orderly market. A designated market maker, DMM, on the NYSE has a unique role that includes an affirmative obligation to maintain a fair and orderly market in the securities for which they are responsible. This involves providing liquidity, narrowing spreads, and ensuring price continuity. Unlike a typical market maker who may choose when and how much liquidity to provide, the DMM has a continuous obligation to support the market in their assigned stocks. This commitment is central to the NYSE's auction market structure. Question 14. Under SEC Rule 10b-18, a company repurchasing its own stock within specific parameters is provided a safe harbor from charges of market manipulation. Which of the following is a condition for this safe harbor? A. The company must announce its repurchase program at least 30 days in advance. B. The company's repurchases must be made during the first 10 minutes of trading. C. The company's repurchases must be made through a single broker-dealer on any given day. D. The company's repurchases cannot exceed 50% of the ADTV, average daily trading volume, of the stock. Answer: D. The company's repurchases cannot exceed 50% of the ADTV, average daily trading volume, of the stock. SEC Rule 10b-18 provides a safe harbor from market manipulation charges for issuers repurchasing their own stock, provided certain conditions are met. One key condition is that the volume of shares repurchased on any single day cannot exceed 25% of the security's average daily trading volume, ADTV, over the preceding 4 calendar weeks. The question used 50% as a distractor, but 25% is the correct volume limitation. The rule aims to allow legitimate share repurchases while preventing them from being used to artificially inflate the stock price. Understanding these volume limits is crucial for compliance in share buyback programs. Question 15. The best execution obligation for a broker-dealer primarily requires them to: A. Execute customer orders at the fastest possible speed. B. Route all customer orders to the market center with the lowest fees. C. Seek to obtain the most favorable terms reasonably available for customer orders. D. Guarantee a specific price for all customer orders. Answer: C. Seek to obtain the most favorable terms reasonably available for customer orders. The best execution obligation, applicable to all broker-dealers, requires them to use reasonable diligence to ascertain the best market for a security and buy or sell in that market so that the customer's order is executed at the most favorable terms reasonably available under the circumstances. This includes considering price, speed, likelihood of execution, and order size, among other factors. It does not mean guaranteeing the absolute best price or fastest speed in every instance, but rather exercising due diligence to achieve the best outcome for the client. Always remember it's about reasonable diligence to get the most favorable terms, not perfection. Question 16. A firm operating a proprietary trading desk must establish and maintain a system of supervisory controls reasonably designed to ensure compliance with: A. Only FINRA rules related to communications with the public. B. All applicable securities laws and regulations, including anti-manipulation rules. C. Only rules related to customer account opening procedures. D. Only rules related to institutional sales. Answer: B. All applicable securities laws and regulations, including anti-manipulation rules. Firms operating proprietary trading desks, like all broker-dealers, have a broad obligation to establish and maintain a comprehensive system of supervisory controls. This system must be reasonably designed to ensure compliance with all applicable securities laws and regulations, including those specifically addressing anti-manipulation, like spoofing or layering, reporting, best execution, and financial responsibility. This broad oversight is critical to prevent misconduct, protect market integrity, and ensure the firm operates within the regulatory framework. Effective supervision is key to preventing violations across all business lines, not just specific ones. Question 17. Which FINRA rule prohibits trading ahead of research reports by a member firm? A. FINRA Rule 2210. B. FINRA Rule 5280. C. FINRA Rule 5270. D. FINRA Rule 5240. Answer: C. FINRA Rule 5270. FINRA Rule 5270 specifically prohibits a member firm from trading ahead of a research report. This means that once a firm has knowledge of the contents or recommendations of its own forthcoming research report, it cannot trade for its own proprietary account in a manner inconsistent with the report's recommendations before the report is disseminated to the public. This rule prevents firms from profiting unfairly from material non-public information generated internally, ensuring fair access to information and promoting market integrity. It's about preventing the firm from taking advantage of its own upcoming analysis before clients can act. Question 18. A broker-dealer executes a trade for a customer that results in a net capital charge due to the nature of the transaction. This charge is imposed to mitigate A. Credit risk. B. Operational risk. C. Market risk. D. Systemic risk. Answer: A. Credit risk. While market risk relates to price fluctuations, a net capital charge arising from a customer trade that hasn't settled, particularly if it involves an unsecured debit or a fail to deliver, is primarily designed to mitigate credit risk. This refers to the risk that a counterparty, in this case, potentially the customer or another firm, will default on their obligation, leading to a loss for the broker-dealer. Net capital rules ensure that firms have enough liquid assets to cover such potential defaults, protecting the firm and its clients. Question 19. An equity trader observes several rapid, aggressive bids and offers being placed and then immediately cancelled on an exchange, creating a false impression of significant buying or selling interest. This activity is indicative of A. Market making. B. Hedging. C. Spoofing. D. Arbitrage. Answer: C. Spoofing. Spoofing is a prohibited manipulative trading practice where a trader places large, non-bona fide orders, bids or offers, with the intent to cancel them before execution. The purpose is to create a false impression of supply or demand, influencing other traders to react to the artificial market interest, often allowing the spoofer to execute legitimate orders at more favorable prices. This behavior is a clear violation of anti-manipulation rules because it distorts market prices and undermines fair trading practices. Identifying such rapid, aggressive, and then cancelled orders is a key indicator of spoofing. Question 20. Under FINRA rules, what is the maximum permissible markup or markdown on a riskless principal transaction in a non-NMS stock, absent other factors? A. 1%. B. 2%. C. 5%. D. It is not a fixed percentage, it must be reasonable based on the circumstances. Answer: D. It is not a fixed percentage, it must be reasonable based on the circumstances. While the 5% policy is often cited, it's a guideline for markups and markdowns, not a strict rule, and it applies primarily to agency and riskless principal transactions, generally in equity securities. However, FINRA rules do not specify a maximum percentage. Instead, they require that markups and markdowns on all transactions be fair and reasonable, taking into account all relevant factors such as the type of security, its availability, transaction size, and the services provided. The 5% guideline serves as a useful benchmark, but the ultimate standard is reasonableness based on specific circumstances. Question 21. Which department within a broker-dealer is primarily responsible for ensuring the accurate and timely settlement of securities transactions? A. Sales and trading. B. Research. C. Operations/back office. D. Compliance. Answer: C. Operations/back office. The operations or back office department within a broker-dealer is primarily responsible for the post-execution activities related to securities transactions, including clearance, settlement, and record-keeping. They ensure that trades are accurately processed, funds and securities are exchanged correctly, and all regulatory reporting obligations are met. While sales and trading execute the trades, and compliance oversees adherence to rules, operations is the engine that ensures the smooth and accurate completion of every transaction. Think of the back office as the critical function that makes sure every trade gets home. Question 22. A FINRA member firm's registered representative receives an order from a customer. The firm's policy dictates that such orders must be routed through its internal ATS, alternative trading system, before being sent to an external exchange. This is an example of A. Market-making obligation. B. Order handling practice. C. Best execution violation. D. Broker-dealer compensation. Answer: B. Order handling practice. This scenario describes an order handling practice, which refers to the procedures and policies a broker-dealer employs for receiving, processing, and executing customer orders. While such a policy must ultimately comply with the best execution obligation, the description itself points to a specific internal routing protocol. Firms establish various order handling practices, sometimes involving internal crossing networks or dark pools, like an ATS, before external routing. These practices are subject to scrutiny to ensure they do not compromise best execution. Question 23. A broker-dealer holds a large block of an NMS stock in its proprietary account. To sell this block without significantly impacting the market price, the firm decides to sell it over several days, slowly feeding the shares into the market. This strategy is known as A. Painting the tape. B. Parking. C. Tapering. D. Order slicing. Answer: D. Order slicing. Order slicing, also known as working an order, involves breaking a large order, in this case, a large block of stock to sell, into smaller, more manageable pieces that are executed over a period. This strategy aims to minimize market impact, prevent significant price disruption, and achieve a better average execution price than selling the entire block at once. It is a legitimate trading strategy, distinct from manipulative practices like painting the tape or parking securities. Question 24. Under FINRA Rule 5290, Order Audit Trail System, OATS, which of the following is not a required reportable event? A. Order receipt. B. Order modification. C. Order cancellation. D. Customer's personal income. Answer: D. Customer's personal income. The Order Audit Trail System, OATS, under FINRA Rule 7400 Series, which superseded Rule 5290 with the implementation of CAT, requires member firms to report specific lifecycle events of an order for NMS stocks and OTC equity securities, including order receipt, modifications, cancellations, and executions. This data is critical for regulators to reconstruct trading activity and surveil for market manipulation. A customer's personal income is confidential financial information relevant for suitability but is not an OATS reportable event. OATS focuses on the order itself, not the customer's financial details. Question 25. A broker-dealer is engaging in risk arbitrage. This strategy involves A. Profiting from small price discrepancies between different markets for the same security. B. Taking a long position in a target company's stock and a short position in the acquiring company's stock in a merger or acquisition scenario. C. Buying and selling a security simultaneously to profit from its dividend payment. D. Providing liquidity to the market by continuously quoting both a bid and an offer. Answer: B. Taking a long position in a target company's stock and a short position in the acquiring company's stock in a merger or acquisition scenario. Risk arbitrage, also known as merger arbitrage, is a speculative investment strategy that aims to profit from the completion of a merger or acquisition. It typically involves buying the stock of the target company and sometimes simultaneously short selling the stock of the acquiring company, betting on the deal's successful completion and the convergence of their stock prices. This strategy involves risk, because if the deal fails, the positions can incur significant losses, distinguishing it from traditional arbitrage which seeks to exploit risk-free price discrepancies.